All right, welcome back. So in today's video, I actually want to try something a little bit different. And the way we play this game, I've actually been getting a few questions about, say, how do you get into the laundry industry? How do you even get financing to even pay for, say, the machines or get things started up? So I actually have one of the channels I watch pretty frequently by ClearValue Taxes. No, ClearValue. It's ClearValue Tax by Brian Kimc. So he has a channel where he goes off a lot of different, things that's happening in the finance world, accounting, taxes, news that's going to affect your money, et cetera, et cetera. So I'm going to have Brian kind of talk about the different forms of loans that you can apply for, and then come back and relate it to what are some of the best options to use when either starting a laundry store or even a laundromat to even get yourself up and running. So let me let Brian Kimc handle that while we play the game in the background. All right, let's go.
In today's video, I'm going to teach you how to get a small business loan. So in today's video, we're going to cover the different types of business loans, where you go to get a small business loan, what you need to qualify, how much that you qualify for, and how to increase your chances of approval. So let's start with this very important question. Which small business loan or financing is the best for you? To answer that, you must be aware of the most popular forms of small business financing. So there's the term loan, SBA loan, a business line of credit, equipment financing, revenue-based financing, microloans. So these are the most popular ones. Of course, there are others as well. But each of these have their pros and cons, and some may be better for certain situations or industries. But listen, regardless of the type of loan, always check the terms for fees, guarantees, collateral, and early repayments, among other things. Now, before we proceed, I want to be fully transparent with you. My company, ClearValue Lending, offers all of these forms of financing. So term loan, SBA loan, business line of credit, equipment financing, revenue-based financing, microloans. So I'm going to leave a link for you down below. Anyways, I'm telling you this because I want you to know that I'm not going to play favorites and try persuading you whether one is better than the other. I believe that you should get what best suits you. And each of these has their pros and cons. Okay, so let's get started with a small business term loan. So with a term loan, you receive a lump sum of cash, and you repay the loan with a fixed monthly payment for a certain period of time, and the interest rate is fixed. So the pros of a business term loan are that they're typically lower interest rates, and term loans will have higher borrowing amounts compared to other types of small business loans. Now, the cons of a business term loan are that they're going to be more difficult to qualify for. So we're talking about being based off your personal credit score, the age of your business, and history of revenues. Now, let me tell you about SBA loans. So a small business administration loan, or SBA loan, is a small business loan that's partly guaranteed by the SBA, which is a government agency. So I want to be very clear about this. The SBA does not give the loan. The SBA just guarantees a part of the loan to the lender. And I want to point out that an SBA loan can have a fixed or variable interest rate. It depends on the type of SBA loan. So the pros of an SBA loan are that they're going to be among the lowest of interest rates and longer repayment terms. So SBA loans are considered long-term business financing, which means that the repayment period is typically longer. Now, the cons of an SBA loan are that it's the application process. It's a long one. I mean, it could be as short as 10 days to get funding, or it could be as long as 90 days. And SBA loans are going to be more difficult to qualify for. So for example, higher credit score requirements. Most lenders, they want to see a minimum personal credit score of around 620, but they're typically, that's the bare minimum. They're typically looking for 690 or up. And you also must show a strong business history. We're talking about cash flows. Now, let me tell you about a business line of credit. So a business line of credit works like a credit card. You borrow when you need to. So you only pay interest on the money that you've borrowed. So let's just say that you get a $50,000 line of credit. That means that you can borrow up to $50,000 whenever you please. So you could think of that $50,000 in this example like your credit card's borrowing limit. So in this example, if you draw $20,000 from your line of credit, then you'll start getting charged interest on the $20,000 that you borrow. And you'll have to make payments based on only the amount that you borrow. Again, like a credit card. And if you pay that money back, then you stop getting charged interest. Again, like a credit card. So the pros of a business line of credit are that they give you flexibility and they also give you revolving access to funds. Now the cons are, you have to watch out for the fees. We're talking about maintenance fees, annual fees, draw fees, etc. Please watch out for those. Now another con is that you may have a variable interest rate, which means that your interest rate may change. So there's some uncertainty there. And another con of a business line of credit is that there are stricter requirements. Now let's move on to equipment financing. So equipment financing is used to acquire business equipment, which can be pretty broad. So this includes office furniture, machinery, commercial kitchen equipment, medical equipment, industrial equipment, etc. So in equipment financing, the interest rate is typically fixed and the equipment becomes collateral. So a pro tip is that it's easier to get financing for equipment that retains value. It's much more difficult to get financing approved for equipment that does not hold resale value. So the pros of equipment financing are that it allows you to keep cash on hand, and it allows you to own the equipment instead of renting it. So the cons are that this type of financing, it's of course limited to equipment, and it may require down payments, but not in all cases. Now let's cover revenue-based financing. So revenue-based financing is alternative financing that's different from a traditional loan. So this type of financing has no interest rate. Instead, there's a factor rate. So here's how it works. Let's just say that you request $100,000, but the deal is that you will have a factor rate of 1.15. So in this case, you would need to pay back $115,000. So with revenue-based financing, you can determine the frequency of your payments. You can choose to make your payments monthly, weekly, or even daily. However, most people choose weekly payments. And typically there are discounts for early repayments. The pros of revenue-based financing are that it's easier to get approval compared to a traditional loan, and fast funding compared to a traditional loan. The cons are that it can be a higher cost of financing. Now let's cover microloans. Microloans are business loans that offer financing for smaller amounts. We're generally talking about from $500 to $50,000. So these types of loans, they're generally a good fit for businesses that need smaller amounts of financing. So some microloans may have variable interest rates, but most microloans will have fixed interest rates with fixed payments. Now, I want you to be aware that microloans, as you can imagine, they're not big money makers for large banks because they're dealing in smaller amounts, right? So it may be more difficult for you to get a microloan. So the pros of a microloan are that they can get you smaller financing amounts that large lenders are not willing to offer you, and they can help build your credit. And the cons are that microloans typically have higher interest rates compared to other loans because they're considered higher risk. And there are fewer lenders, that offer microloans compared to other loans. Now let's talk about where you go to get a small business loan. Well, the first thing I want to tell you is please check out my company, ClearValue Lending, which helps small businesses like yours get financing. So I want to tell you this, I'm very excited to tell you this, that we built our company to revolve around technology and AI to cut down on overhead costs dramatically. And with the money that we save, we can pass that savings on to you. So honestly, we are taking the industry by storm. And we keep the process simple and transparent. Please come check out our site and see how much that you qualify for. So I'll leave a link for you down below. But besides ClearValue Lending, here's some alternatives for you. So you can get a small business loan from banks, credit unions, online lenders, or from the SBA. So getting a loan from banks, credit unions, or an online lender, that's pretty straightforward, so I'm not going to expand upon that. But I want to clarify with the SBA. So this is straight from the SBA website. The SBA partners with lenders. So it's not the SBA that's giving you the loan. Again, the SBA is simply guaranteeing a part of your loan to the lender. So if you visit the SBA's website, which is at sba.gov, then you'll see here that you can find lenders on the SBA's websites. So once you click that, that will take you here to where you can get connected to a lender. Now let's answer this question. What do you need to qualify for a small business loan? The answer is that it depends on what type of small business loan that you're looking for. But here's a general guideline of what lenders will have as a requirement. So regarding your credit score, all loan types will take into consideration your credit score. At a bare minimum, you need to be in the 600 plus range. So regarding collateral, so most SBA loans require collateral. So there are some exceptions, of course. For equipment financing, the equipment will become the collateral. So you don't need collateral for term loans, a business line of credit, or microloans. However, if you offer collateral, then you can get a lower interest rate. So no collateral is needed for revenue-based financing. Now, regarding the minimum age of your business, generally there is a requirement. Of course, yes, there are some exceptions, but generally they want to see at least 12 months. Now, in terms of revenue requirements, generally, yes, there are revenue requirements. Of course, there can be exceptions, but lenders will request your previous few months of banking activity. So listen, not only will these factors be used to approve or deny you, but these factors will also determine your interest rates. However, if you're lacking in one area, a lender may still approve you if you fulfill or exceed in another area. Now, this is a very important question. How much do you qualify for? So you know what, and you're probably not going to be surprised, I'm going to be very honest with you, this depends on so many variables. Your cash flow, potentially collateral, your credit score, industry, time in business, type of loan requested, etc. So to make your life easier, I would encourage you to just come to our website. We built the calculator for this, and you can get a free estimate of how much you qualify for. So I'm going to leave a link for you down below. Now, how do you increase your chances of approval or your funding amounts? Now, I want you to know this about small business loan approvals. The stats on whether your small business loan request will be approved or not vary greatly. It depends on the source. But regardless of what source that you're pulling from, they all show the same thing, that large banks are less likely to approve you compared to a smaller bank or a credit union. And that small banks and credit unions, they're less likely to approve you compared to an online lender. So many people like to start at a large bank because they may already have a relationship at that bank. But if you get rejected by a large bank, try a smaller bank or a credit union. And if you get rejected by a smaller bank or a credit union, then try an online lender. So ultimately, to increase your chances of approval, try smaller banks, credit unions, or online lenders. And just so you know, online lenders, they're growing in popularity. So if you look back at 2019, 19% of all small business loans came from non-bank lenders. In 2025, that's increased to 25% of all small business loans. And of course, go with the option that offers a competitive interest rate, good terms, and the type of financing that best suits you. And to improve your chances of getting a small business loan, you essentially need to reduce the risk of the lender. So essentially, you got denied because you're classified as a higher risk. Because either your credit score is too low, you don't have enough cash flow, or you don't have a sufficient history to their liking. So you can improve your odds by improving your credit score, which I've dedicated a separate video to. So one of the quickest ways to boost your credit score is to fix any credit report errors. So personally, I did this and my credit score jumped by 100 points practically overnight. Also by applying for the right amounts. So you want to request a loan amount that is aligned with your revenue. And also maintaining good banking practices, which we're going to cover in a separate video. So for example, the industry standard is 5 negative ending days. So 5 NEDs will get you denied or severely hurt your chances. Also paying down your pre-existing debts, which lowers your debt to income ratio. Offering collateral is always an option, and improving your financials by increasing your revenues or profitability. So listen, I just want to tell you that I'm a small business owner too, and 2 times in my past, I've taken out small business financing. So I just want to let you know that I am sincerely rooting for you, and I wish you you and your business the very best. Thank you so much. Please subscribe, and I wish you a very nice day. Take care.
Now that was some great words from Brian from ClearValue Tax. Now I got to make this clear. It's not an ad for him whatsoever. I'm actually proud of him that he's able to expand to be able to lend money out now compared to where he was originally. But again, this is not an advertisement for him or his business whatsoever. Now, with that being said, let's go into some of the best options regarding starting off in either a laundry store or a laundromat. Now, focusing on say for instance this type of laundry store based off the game, you want to do some creative, lending in regards to setting up a store like this. So one option is probably the best option, especially if you do not have a great credit score or don't have a lot of collateral or a big amount of cash flow in starting up your business, would be to do a equipment financing on said equipment. Say these washers here, you wouldn't need this many washers for a laundry store because you're just starting off. Again, in the beginning of the game, I did two washers and two dryers. In today's time, that will be considered, say, roughly maybe 3,000. Let's say $4,000 for you to do that. Oh geez, I messed up here. Let's say 4,000, roughly doing that. To just, get started with the equipment. It will be pretty easy getting equipment financing loan with that. This way you don't have to put up any collateral on your end. And then in regards to having some cash flow for the business, start marketing and things like that, I would suggest getting, say, a line of credit from either your bank or the credit card company. Hopefully you have a good enough history with them to get a good amount of a line of credit. If not, use your credit cards. That's, it's an option. Is it the best option? No, because of the amount of interest that you're going to be paying, but it's an option to kind of get your business up and started. Now, one of the things he did mention was like a revenue-based loan. Typically, you're not going to be able to get that, especially if you're just starting off in any portion of the business, a laundry store or a laundromat, or even the pickup and delivery. It'll be harder for you to get a revenue-based loan due to, since your business, it's just starting off and doesn't really have enough time in the game to showcase the amount of revenue. All right. Now, another thing with the SBA loan situation. Now, not even SBA loan, just a loan from the bank in general. It's going to take a while to even get approved for that. Again, it's almost like filing, not filing, it's almost like, filing for getting a home. The amount of information they want from you is from as far as your credit history, your work history, your knowledge based in the business. Even some places will ask you for a business plan just to see, what's your goal and what's your strategy in building up the business. So it's going to be a long, tedious process. Now, the best part about the banks, like Brian said, is it's a term loan and typically it's at a fixed low interest rate in regards to the banks. All right. So, but that is a good option to use in regards to starting it off. So, now if this is something you liked, I'm just taking, hold on. I'm trying to see if I can get back into the newsletter here. I tried that already. Now again, if for instance, if you have collateral for the loan, the best collateral possible would be to say if you own your home, if you have a good amount of stock in your stock portfolio or 401k, you can use that as collateral to starting up your business. Now the downside is it's a personal guarantee on that collateral. If you don't pay, the banks can take those assets to pay off the loan that you got. Typically, you want to do those type of loans if you're asking for 6 figures or more. Anything lower than that, you can go with the microloans or something with a lower interest. So, but let's take a look at what we did today in regards to revenue wise. All right, so we did 14 orders and $84.32. Now, I wanted to make a note about this because I've been noticing this. Now, in real life terms, say we did 14 orders. In reality, this will be, say, $840, $843.20. So we 10 times it based off the revenue, because that'll be a more realistic number and how much you will actually make in, say, in real life if you did 14 orders.